I'm sure everyone who's clicked on this video has surely come across the term ETF, or exchange traded funds. But what if I told you that there's another investment vehicle exactly like the ETF, but it works in the opposite way? In this video, we'll be taking a deep dive into inverse ETFs. If you're interested, please continue. So, what's an inverse ETF? Well, according to Investopedia, an inverse ETF is simply an exchange traded fund constructed by using various derivatives to profit from a decline in the value of an underlying benchmark. They are also known as short ETF or bear ETF. To simply put it, the standard ETF investing philosophy is based on capturing the rise of all the markets and just everything going up in an upward trajectory, whereas the philosophy behind the inverse ETF is to capture the decline in the market. And this normally occurs when the market is going negative or there's some sort of downturn in the market. An inverse ETF is very similar to holding various short positions, where the goal is where you borrow money and you essentially hope to sell at a higher price in hopes of repurchasing at a lower price. If you're not sure what a short is in terms of finance, a short position is simply where a trader decides to sell one of their securities in hopes of repurchasing it later or covering it at a lower price point. So you may see most of these things in options, and I'll make a whole video explaining options. A short position can be held from anywhere from a day to a couple of months to even years. It depends on the contract. But in terms of inverse ETFs, the general consensus and practice is to sell it within the same day you purchased it to avoid massive losses. And I know this can seem like gambling, and it quite honestly it is, because you're trying to predict the market, but this is a strategy only used by very advanced or sophisticated investors. So if you're new intermediate, please don't try trading with margin pretty much alone, as if you haven't seen the Robinhood stories, please Google them and you understand why you don't do this. So what's the difference between an inverse ETF and a short position? Because he said they're quite similar, and they do sound quite similar. Well, the main difference or an advantage with the inverse ETF is that the broker doesn't require you to hold a margin account. And this would not be the case with a short position, where you'd have to hold a margin account. And what that simply means is that, let's say you're trying to short Apple or something and the stock just goes sideways and it just goes downhill. The lender is giving you money. So a margin account is simply the lender letting you borrow money. And what does that mean? You'll have to pay that borrowed money back. And that is why margin is quite a scary thing, and it should only be done by advanced investors, not rookies, especially the people on Robinhood, definitely not. So that's the main advantage. So if an inverse ETF, just go sideways, you won't have to go and sort of get a loan to sort of pay for that, which is a really good thing. Just as I've mentioned the concept of borrowing and margin accounts, there's also another form of ETF, which I thought I'll cover in this video. Leveraged ETFs use derivatives and debt to magnify the result of an underlying index. And this usually happens in ratios of like 2 times or 3 times. So yeah, you can leverage with standard ETFs and get double the gains, but also you're going in debt, so you gotta be careful. Let's do an example. Let's say you have a double leveraged ETF against the S&P 500. And let's say the S&P 500 falls by 2%. That means as you have the double leveraged inverse ETF, you will make a 4% gain. Obviously that's excluding any commissions and any other fees. And that's quite good. So if you get it right, you can make a lot of money. But as I've said once and I've said twice, I'll keep saying, this is a big no-no for the average investor. Just take a look at Robinhood stories. People have lost thousands. And I've made a video prior to that where a teenager actually killed himself. Yep, this is very dangerous and you gotta be very careful with this. I'll now highlight the pros and cons of the inverse ETFs directly from the Investopedia website. So the first pro of an inverse ETF is that inverse ETFs allow investors to make money when the market or the underlying index declines, which obviously makes sense because you were trying to get the downward trend of the market. A second pro is that inverse ETFs can help investors hedge their investment portfolio. And that is true. So many people often criticize hedge funds, and I do understand because their ETF normally performs better and they do a lot of fees, but that's not the point. The point of a hedge fund is actually to just manage the money and keep it safe. They're not interested too much in profits. They're just interested in like keeping the money safe and preserved. And I'll make a video explaining that as well. Another pro is that There are multiple Invest ETFs for many of the major market indices. So obviously, you might do like S&P 500 or ASX 200, just whatever you want and whatever you feel like is going to go downhill. Now let's move on to the cons. So the first con is that Invest ETFs can lead to losses quickly if investors bet on the wrong market decision. And that is 100% true. There's no one who's been able to predict the markets. Like they even did a study about like fund managers and like mutual funds against Warren Buffett. After 10 years, they want to see who performed better. ETFs, they're like 10% or so, and mutual funds like 3% or something. So like it's hard to time the market. The second con is that Invest ETFs held for more than one day can lead to losses. That's what I was iterating to before. It's the general consensus to sort of trade in the first sort of day, sort of like day trading pretty much. The third con is that higher fees exist within Invest ETFs versus traditional ETFs. And that's 100% true. Management fees can go to like 0.90%. That's quite a lot. Whereas like if you had like IOZ, which tracks the ASX 200, the management fee is only 0.09%. That's a big difference. And once your portfolio grows tremendously, you'll understand how much a difference like a small percentage can make. Overall, I hope you can see the value of this investing style and using this particular sort of investment vehicle. But let me just make it clear. Sure, you're magnifying returns by leveraging, but you're trying to time the market and it's very hard to do. And as you're magnifying returns or rewards, you're also magnifying your risk. And I hope you can see the benefit or the appeal of a traditional ETF, where it's just set and forget. You pay a low fee, maybe like 0.09 or anything below like 0.0, 0.3. Like very cheap, and you're getting a return everywhere from around 8 to 10%. And if you average that out, it'll be more towards the high end. So I hope you can see the appeal in that. But regardless, I hope this video was educational. It taught you a bit, and it probably maybe got you interested in terms of more finance terms like shorts, positions, and things of that nature. So I highly encourage you to do further on research and do due diligence. But besides that, if you enjoyed this video, please make sure to hit like, hit subscribe, and I'll conclude this video. Thank you for watching. Goodbye.